If you're sitting on 100 ounces of silver right now, I need you to stop whatever you're doing and pay close attention to the next few minutes, because something is unfolding in the silver market right now that most holders simply do not understand. And if you don't understand it, you are either going to panic at exactly the wrong moment, or you're going to miss what could be one of the most significant wealth building windows of the next decade. Let me be very direct with you. Silver just came off the most explosive rally in modern market history. It went from levels most people considered elevated all the way up to a number nobody thought they'd see in their lifetime. And then it pulled back hard. And right now, across forums, in comment sections, in conversations between family members who got into silver together, people are nervous. They're second guessing themselves. They're looking at their stack and wondering if they made a mistake. You didn't make a mistake, but you do need to understand what is actually happening, because the story unfolding right now goes far deeper than a price chart. What's happening to silver in this moment is the product of forces that have been building for years, forces tied to the industrial transformation of the global economy, to the weaponization of financial systems by world powers, and to a structural imbalance between supply and demand that has no quick fix. Once you understand these forces, what looks like a scary pullback starts to look like something very different. Let me take you back to something that happened over 4 decades ago, because history has a way of rhyming, and if you understand what happened then, you'll have a much better map for what's happening now. In the late 1970s, two Texas brothers named Nelson Bunker Hunt and William Herbert Hunt became obsessed with silver. They had watched the United States abandon the gold standard. They had watched inflation rip through the economy, and they had concluded, correctly by the way, that hard assets were the only real protection against the debasement of paper currency. So they started buying silver. Not a little, a lot. At one point, it's estimated that the Hunt brothers and their associates held somewhere between a quarter and a third of all the silver available on the open market in the entire world. And silver did exactly what you'd expect when that kind of buying pressure meets a fixed supply. It exploded. Between 1979 and early 1980, silver went from around $6 an ounce to nearly $50. In today's purchasing power, that move would be staggering. The whole world was talking about it. And then the exchanges changed the rules. The COMEX, the commodities exchange where silver futures trade, suddenly decided to limit new long positions. You could only sell, you couldn't buy. Overnight, the mechanics of the market shifted beneath the Hunt brothers' feet, and silver crashed back down. The Hunt brothers lost billions. The word squeeze entered the financial vocabulary in a way it hadn't been before. And for a generation of investors, silver became associated with volatility, with danger, with the kind of thing that could ruin you overnight. But here's what most people never understood about that story. The Hunt brothers weren't wrong about silver. They were right about the fundamentals. What they got wrong was timing and leverage. They borrowed against their positions. They concentrated everything in a single trade. And when the rules changed, they had no margin for error. The people who held physical silver and weren't using leverage, some of them did very well. Some of them held through the crash, watched the price recover over years, and understood that what the exchange had done was not a reflection of silver's actual worth. It was a reflection of institutional power protecting itself. Fast forward to 2011. Silver ran from about $8 in 2008 all the way up to nearly $50 again. It took 30 years, but silver revisited those Hunt brothers highs, and then it pulled back again. From nearly $50, silver fell back below $20 over the following years. Every silver holder who bought near the top went through years of watching their position underwater. But here's the thing. The people who bought before the run, who understood why silver was moving, and who held through the noise, silver has never returned to those pre-run levels. The floor kept rising. Each cycle left a higher floor. Now look at where we are. Silver just registered an all-time high. A genuine, historic, never-been-done-before all-time high. And now it's pulled back from that peak. The question you have to ask yourself is not, should I panic? The question you have to ask yourself is, what is different about this moment compared to 1980 or 2011? And the answer to that question is what should determine exactly how you think about your 100 ounces. What's different this time is industrial demand. In 1980, silver was primarily a monetary metal and a photographic metal. Photography was a massive consumer of silver. Every roll of film, every X-ray, every print required silver halide compounds. And as digital photography took over in the 2000s, that demand largely disappeared, which is part of why silver spent so many years languishing. But something else was building in its place. Something far larger, far more durable, and far more impossible to turn off. Solar panels, electric vehicles, artificial intelligence infrastructure, advanced electronics. These are the new demand engines for silver, and they are not going away. Every solar panel manufactured today uses silver. It's baked into the photovoltaic cells that convert sunlight to electricity, and there is currently no commercially viable substitute at scale. Silver is the best electrical conductor of any element on the periodic table. And when you're trying to capture and transmit the maximum amount of electricity from a solar cell, you use the best conductor. Full stop. The solar industry's consumption of silver has grown roughly 12 times over the past decade. 12 times. That's not incremental growth. That's a structural transformation. And then there's electric vehicles. A traditional combustion engine vehicle uses a meaningful amount of silver in its electronics. An electric vehicle uses significantly more. Estimates range from 25 to 50 grams of silver per EV, depending on the model and its feature set. The more sophisticated the EV, with all of its sensors, its power management systems, its regenerative braking electronics, the more silver it needs. Global EV deliveries have exploded in recent years, reaching numbers that would have seemed fantastical a decade ago. And every single one of those vehicles requires silver. Not paper claims on silver, not silver derivatives, physical silver, extracted from the ground, refined, and incorporated into the vehicle. Now, here's the supply side of this equation, and this is where it gets genuinely alarming for anyone who thinks silver is just going to produce its way out of this demand surge. Approximately 70% of all silver mined in the world today is produced not as the primary product of a mine. It's produced as a byproduct of mining copper, zinc, lead, and gold. What that means is that silver supply is not primarily driven by the silver price. A silver miner doesn't get to decide to double production because silver is expensive. The copper miners, the zinc miners, the lead miners, they make their production decisions based on the economics of their primary metal. Silver just tags along. This is an extraordinarily unusual supply dynamic. You can't just drill more silver wells when demand spikes. The supply response is muted, delayed, and dependent on decisions made by mining companies that are fundamentally focused on entirely different metals. So you have a demand picture that is structurally growing, driven by the electrification of the global economy, by solar energy rollout, by AI data centers that require enormous amounts of precision electronics, and a supply picture that is structurally constrained. The Silver Institute has documented consistent annual deficits for several years running. Not 1 year of deficit, multiple consecutive years where the world consumes more silver than it mines. And every ounce of that deficit has to come from somewhere, from existing stockpiles, from recycling, from investors who decide to liquidate their physical holdings. Think about that for a second, and think about what it means for your 100 ounces. You are sitting on a tangible, physical, real-world asset that is in structural deficit. The ground beneath this market is fundamentally different from any speculative bubble. This isn't a cryptocurrency built on narrative. This isn't a meme stock that found a moment of internet attention. This is a metal that the global industrial economy genuinely needs more of than it can produce. Now, I want to talk to you about something that very few silver commentators ever explain clearly, and it's something that every holder of physical silver needs to understand: the relationship between paper silver and physical silver, and why a pullback in the paper price doesn't necessarily tell you the full story of what's happening in the physical market. When you watch a silver price quote on your phone, you are watching the price of a futures contract on the COMEX exchange in New York. That futures contract represents a paper claim on silver. For every 1 ounce of physical silver that actually exists in COMEX vaults and can be delivered, there are many, many more ounces of paper contracts trading above it. Analysts who study this closely have estimated ratios that would make your head spin. The number of paper ounces trading relative to deliverable physical ounces has at times reached extraordinary levels. What this means practically is that the paper price can be moved around by large traders, by banks, by institutions managing short positions, without necessarily reflecting the actual supply-demand reality in the physical market. Here's why this matters for you specifically. There are moments in the silver market where the paper price diverges sharply from what's happening in the physical market. We saw hints of this in early 2021 when retail investors organized on social media to buy silver and push for physical delivery. The COMEX premiums, the markup you pay above the paper price to actually get physical silver in your hands, exploded. Dealers ran out of inventory. The paper price barely moved, but if you wanted to actually own silver you could hold, you were paying far above what the future screen was telling you. That divergence, that gap between paper and physical, is one of the most important things to watch in this market. Now look at where we are. Silver just came off a historic run. The paper price pulled back significantly from its peak. But go look at what premiums on physical silver look like right now. Go look at dealer inventory. The physical market has its own story, and it doesn't always march in perfect lockstep with what you see on a trading screen. And here's something I want you to really sit with. JP Morgan, not some small newsletter, not some YouTube channel, not some speculator on a forum. JP Morgan's global research team projects silver prices averaging in the 80s per ounce over the course of this year. Goldman Sachs has had bullish silver forecasts. Major institutional voices that spent years ignoring silver entirely are now doing the analysis and arriving at numbers that validate what physical holders have been saying for years. Why are institutions suddenly paying attention? Because the energy transition is real and it requires silver. Not theoretically, not eventually, right now, today. Solar panel manufacturers in China, in the United States, in Europe are all competing for silver supply. EV manufacturers are all competing for silver supply, and the supply growth simply cannot keep up. When Goldman Sachs runs their models and they see a structural deficit stretching out for years, they don't shrug, they position. And when institutions start positioning in a market that's already structurally tight, the price effects are not gentle. Let me give you another way to think about your 100 ounces. Gold is sitting at extraordinary levels, above $4,500 an ounce. The gold to silver ratio, the number you get when you divide the gold price by the silver price, is historically one of the most important gauges of relative value between the two metals. Historically, over long periods, silver and gold have traded at ratios that reflected their relative scarcity and use. When you look at that ratio today and see how many ounces of silver it takes to buy 1 ounce of gold, you're looking at a number that historically has compressed dramatically during silver bull markets. In 1980, it compressed to a ratio in the low teens. In 2011, it compressed below 30. If you believe gold is going to hold its gains, and there are a lot of very compelling reasons to believe it will, then the silver story becomes about that ratio normalizing. And when you run the math on what normalization looks like at various ratio levels, you start to understand why people who study this closely are very, very focused on silver right now. Now, I want to pause here for just a second and mention something quickly. If you've been watching this channel for a while, you know I always keep a free guide in the description below. It covers the savings strategies that thousands of American retirees are using right now to protect their hard-earned wealth from everything we're talking about. The inflation dynamics, the currency debasement, the market volatility. If any of this resonates with you and you're thinking about your broader financial picture, check the description. It's completely free. Okay, back to silver. Because I want to talk about the geopolitical layer of this story, and I think this is the most underappreciated driver in the silver market today. We are living through a deliberate, systematic effort by a significant portion of the world's nations to reduce their dependence on the US dollar-based financial system. BRICS has expanded. Trade agreements are increasingly being settled in currencies other than the dollar. Central banks around the world have been buying gold at the fastest pace in decades. Not just 1 or 2 banks, but over 50 central banks adding to their gold reserves year after year. Now, gold gets all the headlines in this conversation. Gold is the reserve asset, the headline number, the thing finance ministers mention in speeches. But silver has always moved with gold, often faster and further. And when the global monetary system is in a period of significant structural change, when the dollar's role as the sole reserve currency is being actively contested, the hard metals tend to reflect that tension. We are in that period right now. The dollar has been used as a weapon, through sanctions, through the freezing of foreign reserves, through the SWIFT system. And nation after nation has looked at that and decided they need assets that no government can freeze, no system can block, no political decision can erase. Physical silver in your possession is exactly that kind of asset. Think about what it means that Russia has been cut off from the SWIFT system. Think about what it means that the United States has, at various points, frozen hundreds of billions of dollars of foreign government reserves held in dollar-denominated assets. Every finance minister on Earth watched those moves and quietly asked their own Treasury officials, what portion of our reserves is vulnerable to the same treatment? And the answer, in most cases, was a lot. The response to that realization is diversification into assets that can't be frozen: gold, silver, physical commodities held domestically. This is not a fringe thesis. This is the reality that's playing out in real-time data. Central bank gold purchases at multi-decade highs, China restricting silver exports, India increasing silver imports, the BRICS nations exploring commodity-backed financial instruments. The architecture of the global financial system is shifting, slowly but undeniably, in a direction that is fundamentally bullish for precious metals. Now, I want to say something directly to the retirees and near retirees watching this. If you're in your late 50s, your 60s, your 70s, if you've spent decades building a nest egg through a 401k or an IRA or a pension, you face a specific set of risks that younger investors don't. You don't have the same timeline to wait out a prolonged bear market. A sequence of returns problem, where the market drops hard in your early retirement years, can permanently damage your financial plan in ways that are very difficult to recover from. You need a portion of your portfolio in assets that don't move with the stock market, that don't depend on interest rate decisions by the Federal Reserve, that don't evaporate when the next financial crisis hits. You already understand this intuitively if you own silver. The question is whether your silver is positioned optimally within your overall financial structure. A lot of people who own physical silver hold it outside of any tax-advantaged account, and that's fine. There's real value in having tangible metal in your possession. But there's also a structure called a gold IRA. And yes, these accounts can hold silver too, not just gold, that allows you to hold physical precious metals inside a tax-advantaged retirement account. You get the inflation protection, the geopolitical hedge, the hard asset exposure, and you get to keep it inside the tax structure you've already built your retirement around. With everything happening right now, the fiscal situation of the United States, the debt levels, the geopolitical fractures, the energy transition stress on the financial system, having that hedge inside your retirement structure isn't a nice to have. For a lot of retirees, it's becoming a genuine necessity. If you haven't looked into this, it's worth a few minutes of your time. The information is out there, it's not complicated, and it could be one of the most important financial decisions you make in the next few years. Let me bring this back to where we started, your 100 ounces. You're sitting on approximately $6,000 to $7,000 worth of physical silver at current prices. That position has already survived one of the most violent pullbacks from an all-time high that any commodity market has ever experienced in such a short time. And here's the question I want to leave you with. What is actually different about the fundamental picture today compared to the day before silver hit that all-time high? The solar industry still needs more silver than miners can produce. The EV industry still needs more silver than miners can produce. The AI and electronics industries still need more silver than miners can produce. Central banks and sovereign wealth funds are still moving away from dollar exposure. The gold to silver ratio is still at levels that historically compress during bull markets. What changed was the paper price. What didn't change was any of the underlying reality. Markets do this. They go up in violent surges that scare away the cautious buyers. Then they pull back in ways that shake out the weak hands. Then they go up again, often to levels that seemed impossible, even at the previous peak. The people who understand why they own something are the people who survive the shakeouts. The people who bought silver because they saw a number going up on a chart are the people who sell at the worst possible moment and spend the next several years watching a market they abandoned recover and then exceed everything they thought was too high. You bought silver because you understood something. The dollar is being debased. The industrial world needs silver desperately. The supply simply cannot grow fast enough to meet the demand. The financial system has deep structural problems that hard assets protect against. None of that has changed. The only thing that changed is the paper price. Your 100 ounces is not a mistake. Your 100 ounces is a position. The question now is whether you understand it deeply enough to hold it through the noise, and whether your overall financial structure is set up to take full advantage of what may come next. For the people who've watched this entire video, thank you. And I want to make sure you know something. Check the description below, because I have a free guide down there. And for American retirees who have at least $100,000 sitting in any retirement account, 401k, IRA, pension, anything, There's an offer to get an exclusive one-on-one educational web conference, completely free, completely no obligation. Just mention that you watched to the end. It's only available to American retirees who qualify, and the spots are limited. Everything is in the description. Go check it out. The silver market is not done, not even close. What you're watching right now is a chapter in a much longer story. Make sure you understand that story well enough to stay in it until the ending.